Good afternoon. Welcome to the fourth quarter 2020 Inflation Report. We will begin with opening remarks by BSP Officer in Charge, Francisco G. Daquila Jr., followed by the Inflation Report with Department of Economic Research Senior Director Sino Ronald R. Abenoja, and the Senior Bank Loan Officer Survey Report by Deputy Director Dennis D. Lapid, also of the Department of Economic Research. We are joined this afternoon by Assistant Governor Iluminada T. Sicat of the Monetary Policy Subsector. Governor?
Ladies and gentlemen, good afternoon. I'll be delivering the opening remarks in behalf of Governor Benjamin Jokno. So the BSP is publishing today the 77th edition of the quarterly inflation report, as well as the results of the latest BSP Senior Bank Loan Officers Survey. These reports are part of the bank's continuing efforts to promote transparency in monetary policy by conveying the overall thinking and analysis behind the decisions on monetary policy during the fourth quarter of 2020. The mobility restrictions and quarantine protocols put in place since March of last year helped the government to mitigate the spread of COVID-19 in the country. However, the continued implementation of these measures also weighed down on the economy's performance, as activities in sectors such as construction, manufacturing, transport, retail trade, and tourism have been significantly hampered. As a result, the Philippine economy contracted by 11.5% in the third quarter of 2020, bringing the year-to-date economic growth to minus 10%. Nevertheless, select indicators suggest encouraging signs of recovery. In particular, the gradual improvement in mobility could signify that firms and households are learning to adapt to the post-pandemic operating environment. Additionally, economic confidence improved in the final months of the year, with consumers and businesses seeing better prospects for 2021 in anticipation of the country's continued reopening and the eventual distribution of COVID-19 vaccines. The Development Budget Coordination Committee, or DBCC, expects the economy to grow by 6.5% to 7.5% in 2021, driven by higher government spending and the timely passage of structural reforms, such as the Corporate Recovery and Tax Incentives for Enterprises, or CREATE Bill, and the Financial Institutions Strategic Transfer Bill. To complement the government's various health and fiscal responses to the pandemic, the BSP kept its accommodative monetary policy stance during the quarter to support the recovery. In November 2020, the BSP reduced the policy rate by another 25 basis points to 2.0% for a cumulative reduction of 200 basis points since the pandemic began. This was possible because of the benign inflation outlook, even as adverse weather conditions and supply distribution bottlenecks pushed food prices higher during the quarter. Average headline inflation for 2020 settled at 2.6%, which was on the lower end of the government's target range of 2 to 4%. Meanwhile, the BSP's liquidity-enhancing measures have injected approximately 2 trillion pesos into the financial system, equivalent to about 10% of the country's nominal GDP to date. Ample liquidity in the financial system has contributed to an increase in bond market activity, with improved appetite for government securities. Similarly, the weekly auctions of BSP securities reflected sustained strong demand since their launch in September 2020. However, we note that credit activity remains weak as risk aversion persists in the banking sector. As a result, as the results of our latest senior bank loan officers survey will show, banks tightened their lending standards anew on concerns of a further escalation in non-performing loans. Nonetheless, the BSP remains confident in the soundness and resilience of the banking sector, as capital adequacy ratios have remained well above the mandatory standards. Looking ahead, the BSP sees ample room to maintain its accommodative policy stance in 2021 on the back of a benign inflation outlook and well-anchored inflation expectations. Our latest baseline projections show inflation settling at 3.2% for 2021 and 2.9% for 2022. The recent uptrend in inflation is seen to be largely transitory, reflecting the short-term impact of recent typhoons. The overall balance of risks to future inflation continues to lean towards the downside, owing mainly to the slow recovery of demand and risk of potentially deeper disruptions to economic activity caused by the pandemic. However, upside inflation risks are also a possibility due to supply-side risks, such as weather disturbances and rising crude oil prices. At the same time, the timely distribution and administration of COVID-19 vaccines, along with the continued easing of restrictions, will help to underpin confidence among households and businesses over the next few quarters. Perhaps most importantly, continued support from fiscal policy will play a key role in promoting a robust economic recovery. These developments form the backdrop of the latest inflation report. The full text of the report, as well as the latest results of the BSP's quarterly survey of senior bank loan officers, shall be made available through the BSP website shortly after this video conference. We look forward to your questions on the two presentations for this afternoon. And thank you very much.
Thank you, TG Dakila. We now move forward to the report, Inflation Report by Sir Zino.
Thank you, Alicia. And I join our OIC, Deputy Governor Dakila, our Assistant Governor, Ms. Sikat, and Deputy Director Lapid in welcoming you to this afternoon's press briefing on the fourth quarter 2020 inflation report. So for this afternoon, I will be summarizing the key points of the inflation report. And let me start with the first slide on the key points of the report. The assessment of the monetary policy during the last quarter of 2020 indicate that prevailing monetary policy settings remain accommodative to help quicken the economy's transition toward a sustainable recovery. And underlying this assessment is that actual average headline inflation for 2020 is within the target range, despite the uptick in the fourth quarter 2020. But what is important, we think, is that inflation expectations remain well anchored in 2021 and even up to 2022. The Philippine real GDP continued to show contraction in the third quarter of 2020, the latest available data at that time. However, we observed that the contraction is less than what was previously observed in earlier quarters. And in fact, recent indicators on confidence and mobility are improving. Furthermore, liquidity conditions remain ample due to BSP policy measures, but bank lending activity continues to be tepid. In the external sector, global economic activity is showing modest growth, but uncertainty remains elevated amid the resurgence of COVID-19 cases. Taking into account these various economic conditions, the latest forecast suggests benign inflation environment over the policy horizon, with the risk to the outlook continuing to lean towards the downside. So overall, these economic and financial sector developments at that time continue to indicate that an accommodative monetary policy posture was deemed appropriate for the economy. Now, let me go to some of the key sections, major sections of the report. First, on inflation dynamics. Headline inflation rose to 3.1% year-on-year in the fourth quarter of 2020. This is higher than the 2.5% inflation registered in the third quarter of last year. That brought the average headline inflation to 2.6%, which is well within the government's target range for the year. Tighter domestic supply contributed to higher food inflation during the fourth quarter of 2020. Specifically, food inflation rose to 3.8% during the quarter, due largely to the higher price increases from selected agricultural products. Vegetable prices went up amid crop losses and supply distribution bottlenecks in the wake of recent typhoons. There was also limited supply in terms of fish and even meat, due partly to the African swine fever. Meanwhile, transport inflation continued to rise in the fourth quarter due to higher road transport fares, contributing to the uptick in non-food inflation. In the right-hand side of the slide, we show the developments in terms of core inflation. We see that core inflation, that's the dark blue line, has been generally stable in 2020, settling at 3.2% by the fourth quarter of 2020, which was unchanged from the third quarter numbers. Meanwhile, estimates from the alternative core measure showed a mixed trend. An equally important aspect of inflation dynamics would be the expectations. And in the next slide, we show that inflation expectations remain well anchored, even as transitory shocks pushed inflation higher during the quarter. The results of the BSP survey of private sector economists for December 2020 showed higher mean inflation forecast. The mean inflation forecast for 2021 rose to 2.9% from 2.8%. Meanwhile, the mean inflation forecast for 2022 was unchanged at 3%. Analysts expect inflation to remain benign in the near term, but there are risks which are tilted to the upside as the economy gradually reopens. Now, turning to domestic economic developments in terms of growth, domestic growth in the third quarter of 2020 posted a smaller contraction of 11.5%, as was mentioned earlier in the opening remarks. On the production side, growth in industry and services sector continued to contract at a slower pace as the lockdown measures were eased during the quarter. Meanwhile, output of the agricultural sector increased. On the expenditure side, household consumption and external trade showed signs of recovery, with said sectors posting smaller contractions than the third quarter of 2020. Looking at higher frequency and more recent data, they continue to indicate some weaknesses in the domestic demand. For example, the composite PMI in November 2020 remained below the 50-point expansion threshold at 46.8 index points. Despite the slower contraction of the manufacturing index, this composite PMI dipped anew in the fourth quarter as services and retail and wholesale sectors contracted faster in November. Energy sales of Meralco contracted by 7.7%. The contraction continues to reflect the impact of the implementation of the quarantine protocols implemented in Meralco's service area. Finally, on the right side of the slide, we show the sales of new vehicles, and it indicates a drop by about 30% for the fourth quarter. And this coincided with the occurrence of consecutive typhoons during the October and November period of last year. Nevertheless, we look at other indicators, and they show that mobility indices show improvement in the fourth quarter of 2020. Mobility data showed that mobility in grocery and pharmacy, as well as parks, briefly breached the threshold with the onset of the holiday season. Likewise, the decline in the mobility at the workplace may be explained in part to seasonal factors. Transit mobility has remained tepid amid limited public transportation options. Another indicator that we look at was the confidence indices. Business confidence on the economy improved for the fourth quarter of 2020 as the overall confidence index of the BES, the Business Expectation Survey, reverted to a positive territory at 10.6% from negative 5.3% in the third quarter of 2020. The optimism was attributed to the reopening of businesses and adapting to the new normal, easing of community quarantine nationwide, some seasonal factors, as well as the increase in the volume of sales and orders. This was complemented by the results of the Consumer Expectation Survey. The country's consumer outlook was less optimistic for the fourth quarter of 2020 as the overall confidence index increased, although it remained at a net negative level. According to household respondents, their improved outlook during the fourth quarter was brought about by the expectations of availability of more jobs and permanent employment, additional and high income, effective government policies and programs, including the Social Amelioration Program, and less community restrictions, the opening of businesses, and optimism on the end of the pandemic. Now, turning over to external trends, global economic activity has stabilized. The JP Morgan Global All-Industry Output Index stood at almost 53 index points in December 2020. 5 out of the 6 subsectors covered by the survey registered output expansions during the month, and this was led by the financial services and intermediate goods sectors. In contrast, consumer services activity fell for the 11th consecutive month. While global economic activity has stabilized, it was recognized that uncertainty remains elevated, and this was due mainly to the resurgence of COVID-19 cases across the globe. Moving to the financial sector, domestic liquidity, or M3, expanded by more than 10% year-on-year in November 2020. And this expansion reflects partly the sustained borrowings by the national government. Meanwhile, the outstanding loans of commercial banks, net of RRP placements with the BSP, grew by 0.3% year-on-year in November 2020. Bank lending growth waned in November as the COVID crisis continued to dampen consumer spending and business activity. Specifically, outstanding loans to key industries declined further particularly the wholesale retail trade and repair of motor vehicles and manufacturing sectors. Meanwhile, the demand for BSP deposit facilities remained strong in the last part of 2020. As of end 2020, the total outstanding amount absorbed in the BSP liquidity facilities stood at 2 trillion pesos. Bulk of the liquidity absorbing monetary operations had been the overnight deposit facility, comprising about 57% of the combined amount of liquidity absorbed through BSP liquidity facilities. At the same time, the term deposit facility, the reverse repurchase agreement, and the BSP securities facilities continue to be important elements of the BSP's open market operations. Since the maiden auction of the BSP securities back in September 2020, market reception has been positive in the issuance of these 28-day BSP bills. Thus far, the results that we are seeing from the weekly auctions reflect sustained strong demand amid the ample liquidity in the system. In fact, for the fourth quarter of 2020, total subscription amounted to about 1.42 trillion, or about 1.7 times the aggregated offer amount by the BSP. Now, on the inflation outlook, after taking all of these factors into consideration, the baseline forecast continue to suggest a benign inflation environment over the next 24 months. Inflation is expected to average 3.2% in 2021 and 2.9% in 2022. The forecast revision for 2021 was largely to the higher than expected inflation outturn in the fourth quarter of 2020 and the sharp uptick in global crude oil prices. Furthermore, the BSP's review of the current inflation dynamics suggests that the risks to the inflation outlook are tilted to the downside for both 2021 and 2022. The potential impact on global and domestic economic growth prospects of a more disruptive COVID-19 pandemic is the primary downside risk to inflation. In particular, a possible reimposition of containment measures among major economies as a result of the second wave or third wave of cases and the failure to contain the pandemic despite the availability of a vaccine could further dampen consumer confidence and exacerbate the disruptions in supply chains and trade. In the domestic front, the reimposition of stricter quarantine measures could derail economic recovery and further heighten uncertainty faced by firms and consumers. Nonetheless, there are upside risks also to inflation. The recent uptick in global crude oil prices due to the positive market sentiment, along with the impact of La Nina weather conditions on global food production, could be a source or could be sources of supply-side pressures for 2021. Given the benign inflation outlook during the fourth quarter of 2020, the BSP was able to continue to provide monetary support to the economy. The Monetary Board cut the policy rate by 25 basis points at its meeting on 19 November 2020, and it cited the need to bolster economic activity and boost market confidence amid the resurgence of COVID-19 cases globally at that time. Meanwhile, during the December 2020 meeting, the Monetary Board held the policy rate steady to allow the BSP's monetary responses throughout the year, throughout 2020, to continue to work their way through the usual channels of transmission. To conclude, I summarize in this slide some key points. The BSP was able to observe encouraging signs of nascent recovery amid indications of improved mobility and sentiment. At the same time, inflation is projected to remain relatively benign in 2021 and 2022, with inflation expectations remaining well anchored to the target. The risks around this benign outlook to inflation are tilted to the downside due to a more possible disruptive impact of COVID-19. Given this outlook and assessment, continuing monetary policy support, together with sustained fiscal initiatives to ensure public welfare, should help mitigate strong headwinds to growth. The BSP remains vigilant and stands ready to deploy its full arsenal of instruments as needed in fulfillment of its mandate to maintain price stability conducive to a sustainable economic growth. So that concludes the briefing on the key messages of the fourth quarter 2020 inflation report. Thank you.
Thank you, Sir Zino. We will now proceed to the Senior Bank Loan Officer Survey Report by Sir Dennis. Sir Dennis?
Thank you, Alicia. Good afternoon. Let me take you through the highlights of the latest Senior Bank Loan Officer Survey for the fourth quarter of 2020. So I'm going to jump ahead to the third slide, which is a quick background on the survey. So the purpose of this survey is for the BSP to understand better the attitudes of our banks in terms of their lending to their different categories of clients. This is important because bank lending is one of the major ways in which monetary policy affects the rest of the economy. So it allows us also to gain some insight on the overall strength of credit activity in the country. And the survey itself is quite similar to surveys being done by other central banks like the US Fed, the ECB, the Bank of England, the Bank of Japan, and so on. The survey questionnaire is in 3 parts. So we ask about loans to businesses, loans to households, and also loans to real estate. And the specific questions are as follows. We ask about the different terms and conditions or credit standards. We ask the banks what they think about what will happen to loan demand from their clients. And then we also ask them to enumerate some of the key factors that they think will affect loan demand or credit activity in the next few months. As you'll see in the charts that we'll be showing, we present the data in 2 ways. We show the modal approach, which is basically what the majority of the respondents answered in the question. So it's either tightened, unchanged, or loosened. And then we also present the diffusion index, which looks at among the banks that said that they changed their credit standards. We take the percent that said they tightened and subtract the percent that they said they eased. So that a positive diffusion index means a tightening, and a negative diffusion index means a loosening or easing. And as you'll see in the charts, we look at the data for the latest quarter and compare it with the preceding quarter and the historical period also. In terms of the respondents, in the next slide. So we generally over the years we've gotten very good responses from the banks, and we're very grateful for their continued support of this survey. We started, I think, in 2009 with the survey. Back then, we only had about 35 universal and commercial banks. More recently, we've managed to add, with the entry of new foreign commercial banks. We've added 7. Back in 2018, we've added 7 additional foreign commercial banks. And then on top of that, we added also 22 thrift banks to the survey as response. So in total, we currently have about 64 banks who are receiving the questionnaire. And for this round, in the fourth quarter, we have about 45 banks who gave us their responses, which is a 70% response rate. So we're extremely grateful for those banks that sent in their responses. So on to the results. In the next slide, we show the the responses to changes in overall credit standards. So if you look at the left-hand slide, you'll see that the blue bars representing what the majority said, which is that they maintain their overall credit standard. So 64%, for example, in the case of housing loans, and also for the overall for the overall survey as a whole, 65% of the respondent banks said that they maintain their credit standards. And this is true also for loans to businesses and also for the real estate loans. If you look at the right-hand chart, which is the diffusion index, so you'll see that most of the values are positive. So those are the red bars. That's for the fourth quarter. So which means there was a net tightening across the different loan categories. So loans to enterprises, households, commercial real estate loans, and also housing loans. And so in the survey, the banks attributed their tightening of credit standards to these factors: a less favorable economic outlook, a deterioration of the profiles of their borrowers, and also their profitability of the banks, and also reduced tolerance for risk. So the survey somehow indicates that many banks are still feeling risk averse with respect to their lending. In the next slide, we look at the data across time, which is when we started in 2009, and up to the latest. And so I think the notable the left-hand chart in particular shows the proportion of banks that said that their standards were unchanged. So that proportion has remained quite stable over time, except for the periods in 2009, around the time of the global financial crisis, and also in second quarter of last year, at the onset of the pandemic, when uncertainty was relatively high. And since then, if you look at the second quarter and fourth quarter numbers, where there's been a reduced proportion of banks that saying that their credit standards were unchanged. So we're seeing a little bit of movement, and that's mirrored in the right-hand chart, which is the diffusion index. So we saw a peak in the net tightening of credit standards in the second quarter of last year, and that's become progressively less. So the number of banks that outnumbering those that said that they eased has become less over time in recent quarters. In the next slide, we look at some of the key credit standards themselves, and we show the responses for loans to businesses and loans to households. So the loans to businesses are the light blue bars, and the dark blue bars are responses for the loans to households. So in the case of both business and household loans, there was the net tightening of standards was reflected in terms of reduced or smaller credit lines for clients, and also stricter loan covenants or tighter terms and conditions. For both type of borrowers also, however, there was some easing in terms of narrower loan margins, so banks are absorbing some of the looser liquidity conditions, and also longer maturities being offered to clients. Meanwhile, results for the collateral requirements and use of interest rate floors or minimum interest rates were a little different for the businesses and households. On the one hand, the bank's responses for standards on business loans pointed to a net tightening in their collateral requirements, so stricter collateral requirements for businesses, and also greater use of interest rate floors. On the other hand, the loans for businesses, there was less restrictive collateral requirements, and also decreased or reduced use of interest rate floors. And next, we look at the outlook for the next quarter or for first quarter of this year. According to the survey, over the next quarter, the majority of our respondent banks are expecting to retain their overall credit standards. However, based on the diffusion index, the results show that the banks are anticipating a net tightening of their credit standards, for both for loans to businesses and to households, as well as for the real estate loans. And in terms of the reason for this expectation of tighter credit standards, these are the ones cited: a more uncertain economic outlook, an expected deterioration in borrower profiles, and also bank profitability, and also a reduced overall tolerance among the banks for risk, or for credit risk. Next, we look at what the banks are seeing in terms of loan demand from their clients. And so across different types of loans. On the left-hand chart, you will see the distribution. In terms of the majority response, most of the banks are still saying that they're seeing unchanged loan demand for loans to businesses and also for commercial real estate loans. In contrast, the responses for consumer lending and also for housing loans tended to vary during the quarter, favoring either unchanged credit standards, loan demand, or decreased loan demand. If you look at the diffusion index data on the right-hand chart, the results show that overall loan demand from enterprises generated the net increase, specifically for the top corporations, while the expectation for loan demand from households is a net decline across the different types of consumer loans. And some of the main reasons cited for the overall net increase or expected net increase in loan demand from businesses are the following: higher financing needs for inventory and accounts receivable, and also a decrease in corporate clients' internally generated funds. Meanwhile, for the household lending, the expectation of a net decline in demand is based on their observation of lower household consumption and also lower housing investment. Next, we look at the behavior of the data over time for loan demand. We'll see, again, similar to the earlier time series chart, we'll see some improvement in recent quarters particularly relative to the second quarter of last year. So looking at the results from a historical perspective, the latest results show an increase in the portion of respondents saying that they're seeing unchanged overall loan demand from both businesses and households compared to the last two quarters. And then similarly, on the right-hand chart for the diffusion index, the results show there were fewer banks expecting a net decrease in loan demand. In other words, fewer banks reported seeing a net decrease in loan demand. So this is, I guess this points to some improvement in terms of lending conditions, or at least attitudes among the banks in terms of their credit operations. Next, we look at the outlook for the first quarter. So loan demand outlook for this quarter, first quarter 2021, shows banks expecting a net increase in overall loan demand from enterprises and households. This is associated mainly with their expectations of improved or increased financing needs among businesses for inventories and also accounts receivables, and improved economic outlook, and also lack of other sources of funding. In the case of the expected net increase in loan demand from households, this is mainly based on expectations of higher household consumption and also lower income prospects, which presumably would prompt households to turn to borrowing in order to fund their consumption. So, so to summarize, in this slide, we show the results for the different loan categories. And so the upper part shows the results in the questions on credit standards. So U here means unchanged, and while T means a net tightening. So in the majority responses from the survey that we got is unchanged credit standards across the different categories, if you look at the modal approach. But in terms of the diffusion index approach, there continues to be a net tightening of credit standards. Although as we've seen, if you compare to the previous 2 quarters, there's been a bit of an improvement in terms of lending attitudes. In terms of loan demand, so that's on the lower part of the slide, the results tended to vary for households and real estate loans. So if you look at the modal approach, the majority of respondent banks are seeing an unchanged loan demand from businesses. Meanwhile, an equal portion of respondent banks reported a steady or decreased loan demand for households and residential real estate during the quarter. Now, if we look at the diffusion-based index approach, that's in the very last line of the slide, there's been a net increase or slight net increase in overall loan demand from businesses, while demand from households and demand for household lending and also commercial and residential real estate registered a net decline. So those are the main results of the latest Senior Loan Officer Survey for the 4th quarter.
Thank you, sirs. We will now respond to questions that our media friends sent us this afternoon, as well as any clarifications or follow-up questions that they may have. For the first question, Lee Chipongyan of Manila Bulletin asks, so far, Governor Diokno said the BSP's liquidity infusion to the financial system is not inflationary. But when would it become inflationary? And when the economy starts to recover, would you say that too much liquidity injection by the BSP amid low interest rates could result to higher inflation down the line?
Okay. Yeah. So thank you for the question. Actually, it's a series of interrelated questions. I think it's arising from the concern that liquidity can promote an inflationary situation, either in the near term or when the economy starts to recover. Now, let me first say that the concern about excess liquidity will be more appropriate in a situation where the economy is operating at either close to its capacity level or even beyond capacity. And as we all know, during this pandemic period, there has actually been an unprecedented contraction in our output, and the economy is really operating below its potential capacity. And so I would not say that the liquidity infusion by the BSP would be a concern with respect to its fomenting inflation down the road. Now, again, I'd like to emphasize that the various measures that were done by the BSP to boost liquidity were appropriate in providing the necessary policy support to the economy amid the ongoing pandemic. And this helps ensure that the liquidity is there as necessary support for economic recovery. Once that happens, then there will not be any tightness in liquidity that can constrain our recovery. Moreover, when we look at the second part of the question, it's premising that the liquidity injection by the BSP has been too much. But when we look actually at, as Zeno had reported earlier on, domestic liquidity as measured by M3 expanded by 10.5% in November, and this is even slower than the 12.2% expansion as of the end of the second quarter of the year. So I would not say that the liquidity injection has led to excessive growth in M3 for the economy. Now, again, when the recovery starts, then the liquidity that's lodged in the various instruments of the BSP will be there, and we expect that this is going to be absorbed by the economy as the demand for liquidity rises. And whatever we will be monitoring the situation carefully. Should there be any indications of any possible excess liquidity going forward, then of course I'd like to emphasize that the BSP has a full suite of monetary policy instruments now available. We've now, as Zeno had reported earlier, there's strong demand for the 28-day BSP bill. So we can adjust the levels of all these policy instruments to address any issues pertaining to liquidity. Thank you.
DG, if I may, just
Yes,
just
Dennis,
to
please.
quickly add maybe a couple of points. One is in terms of the monetary response and liquidity provision. I think the BSP took the approach of most central banks in the wake of the current pandemic in providing a significant amount of liquidity and also monetary stimulus to the economy. I think as part of the overall whatever it takes approach that was adopted by many central banks across jurisdiction. As this is in recognition of I think the nature of this shock as being an unprecedented one and also a widespread one as well. And in terms of preventing all that liquidity injection from turning inflationary, I think the key, as the Deputy Governor said, that the key consideration will be the timing of the withdrawal of the stimulus. So we will be, I think, the BSP will continue to be to follow its time-tested, data-dependent approach to monetary policy decision making.
Thank you, sirs. The next set of questions come from Warren de Guzman of ANC. He asks, what is the trajectory of inflation this quarter? I think he means the first quarter of 2021.
Yeah.
And what are the biggest upside or downside risks? Is it possible for inflation to fall below 2.5% before the second quarter?
Okay. Again, Zeno had given the baseline inflation path in his presentation. And if I may mention the numbers again, we see these are the numbers that were the basis of the Monetary Board decision. last December 17. So for 2021, we see inflation averaging at about 3.2%. And for 2022, the average will level off at 2.9%. So from that, you can see that the trajectory of inflation would be for you to have a 3.2% annual average, then most of the year, inflation should be above the midpoint of the target band. Now, as you know, last December, we've had an uptick in inflation to 3.5%, and that is attributable to weather-related disturbances, short-term impact, and also higher oil prices. So these are both on the supply side. So we see that the impact of these factors will be concentrated more on the first half of the year and perhaps continuing a little bit into the second half. But later on, inflation can drop to below the midpoint of the target towards the last half of the year, again being driven by this time base effects. So I'd like to emphasize that even as we see an average of 3.2%, as was mentioned earlier, the balance of risks to the inflation outlook is on the downside. That means when we look at all the different possibilities, it's much more likely that you can have an average that is a little bit below 3.2% for the year rather than higher than 3.2%. And again, the main downside risk, and this was already mentioned during the presentation, that arises from the possible further dampening effects on economic activity of COVID-19. Again, the upside risks I've already mentioned, but these are really on the short term, arising from supply side bottlenecks because of the weather-related disturbances. If anyone wants to add anything else.
Okay, thank you, sir. For the next question, also from Warren de Guzman, considering the inflation environment, how much space does the Monetary Board have in terms of policy adjustments to help stimulate the economy?
Again, thank you for the question. Again, I think it bears emphasizing that we came into this pandemic when the economy was in a position of strength. So all through this pandemic, the inflation situation has remained benign. And that really is the basis for our saying that we have ample room to keep the overall stance of monetary policy accommodative. That is, I would not say that inflation would be an overriding concern at this point. The uptick that we are seeing would be emanating from temporary supply side considerations. So again, the overall bias is for further monetary policy support as necessary to ensure that there is proper underpinning of a sustainable economic recovery. And again, apart from the policy rate, then of course we do have the full menu of other possible adjustments that can be done, including as the governor has said that the commitment is to lower the reserve requirement ratio to single-digit levels by the end of his term. Of course, the open question is the remaining path of that adjustment, and that will be guided by the need to provide liquidity to the economy, as well as, very importantly, the outlook for inflation. So all throughout, the policy stance will remain data dependent.
Thank you, sir. The next question comes from Prince Magtulis of Philstar.com. Inflation surged to 3.5% year-on-year in December, the fastest in nearly 2 years. At the time the report was released, the BSP has maintained that higher prices are transitory in nature because of the impact of typhoon damage on food supply. However, anecdotal evidence on the ground suggests that food prices remain elevated while oil prices are ticking up. Does BSP think that faster inflation at this point remains transitory and does not warrant monetary action to be addressed? Or has the assessment at least slightly changed given price upticks? More broadly, does BSP think that its last rate cut last year did more harm than good given that prices are elevated right now, consumer demand may be hurt, and recovery may be hampered?
Well, I'll address the last part of the question first. As to the rate cut doing more harm than good, definitely not. Because when you look at as Prince had mentioned, the latest uptick in inflation, that is clearly attributable to short-term considerations. I would say that it would have happened whether or not we had made the policy adjustment. But you can really see that when you look, for example, at the December inflation numbers. So we know that the average is at 3.5%. But when you look at the regions that have the highest inflation rates, I'll just mention this region 2 was at 6.6%, and then region 3 was at 4.5%. The Calabar zone was at 4.4%, and the Bicol region was at 6.6%. So what are the common characteristics of all these regions? Where they were the regions that were most affected by the typhoons Quinta, Rolly, and Ulysses. So you look at the distribution of inflation, the geographical distribution, and it really is supportive of the assessment that the uptick in inflation is due to weather-related disturbances. And that's really in line with what Prince also mentioned, that for now, the food prices have remained elevated. Thank you.
Thank you, DG.
If you want to add or... yeah, Zeno?
Yeah, thank you, DG. Just to add to the points that you gave, DG, when we look back at our framework, the inflation targeting framework, whenever there are supply-side shocks, it does not immediately warrant a monetary policy action, given that supply-side shock the impact could decrease, and the base effects will start to kick in over a 12-month horizon. So what we do is that we will we will continue to be vigilant. We'll take a close look at developments and see if these supply side shocks will eventually lead to second-round effects, and that's where monetary policy action may be considered. But as DDG has emphasized, the outlook continues to be benign. We see that this shock is geographical in nature. It's shaped by what happened in terms of the typhoon, and so monetary policy may not be considered in this particular case. Yeah. So just to add to that point, Lisha. Thank you.
Thank you, Zina.
Thank you, sirs. The next question still comes from Prince Magtulis of Philstar.com. Has the Philippines at this point reached the point of stagflation, technically defined as anemic growth and soaring prices? If not, is the Philippines at risk of such this year?
Now, if you look at the definition of stagflation that was mentioned, there are two conditions: anemic growth and soaring prices. And by that you can see that we do not have soaring prices. So there's no stagflation happening, and I don't think there's really a threat because the main reason is that we see inflation keeping to within the target range over the policy horizon. Again, 3.2% for this year and 2.9% for next year, as well within the inflation target. And so I don't think it can be characterized as really as a runaway inflation environment, which is the characteristic of stagflation. Another characteristic of a stagflationary episode is that the inflation developments begin to feed in to expectations. And as Zino had given out the numbers earlier, the numbers coming from the different surveys conducted by the BSP are all consistent with the inflation remaining anchored to, actually they're all very close to the midpoint of the target range. Now, again, stagflation is also characterized by weakness in demand. Again, this one we've already alluded to, but the thing is that the demand weakness that we have seen is really attributable to the constraints that have been imposed in order to keep the virus from spreading. And if you look at the various indicators of demand, we're already seeing improvement. This we all know very well. GDP, although it continues to be in contraction, well, it's from minus 16.9 in the second quarter. It recovered to minus 11.5 by the third quarter. And then when we look at our expectation survey for the business sector, it has actually reverted back to positive territory from minus 5.3% in the third quarter to 10.6% in the fourth quarter. And then for consumer expectations, although it remains negative, there has also been some recovery. So it's still negative from minus 54.5% to minus 47.9%. But we see at least a pick up in consumer expectations. So again, I don't think this can be characterized as a stagflationary episode.
Thank you, sir, for our additional questions.
Yes, please.
Set of additional questions this afternoon from Eileen Mencias of Abante.
Yeah.
How does a negative interest rate environment affect inflation and growth? And what does it suggest if a negative interest rate environment fail to spur demand and loan
Yeah.
growth?
Okay. Now, first to clarify, we have a negative real interest rate. That means when you look at the inflation rate and compare it to the nominal the policy rate, then the policy rate in real terms is negative. But we do not have a negative nominal interest rate environment, which should be the more worrisome kind, because that means that you are now running out of policy space. Now, again, a negative real interest rate would be more worrisome if you have a situation of excess demand. And that's something that I've already mentioned. And that is not the case for us. So I would not really say that that should be a cause for worry. It provides a boost to demand. But again, the main factor that should be decisive in boosting demand would be our ability to control the spread of the virus, because that is really where the problem originates. And again, also in that respect, added government spending would be a direct contributor to demand. So if you look at the menu of instruments, it's typical that the monetary policy can come early on, because you can do that in a much speedier way, but then there's a lag in the impact of monetary policy. On the other hand, now fiscal spending, targeted government spending done judiciously will provide great stimulus to the economy.
Thank you.
Thank you. If anyone wants to add again, I can see Dennis.
Just to quickly say, the DG, that negative real interest rates are exactly the kind of response that you need in the current climate, where you have a large contraction in demand, and as was pointed out before, much of the pressures that we're seeing in terms of inflation are coming from the supply side, which I think the thing about supply side pressures on prices, that most of them tend to be concentrated in specific commodities, and in most cases, I think they can be remedied through non-monetary intervention, like let's say allowing imports of food, for example, to augment domestic supply. So and these things Past experience tells us that these things tend to resolve themselves over over a few months. So it's something that not necessarily might require a monetary response. I think it's also important to point out that certain increases in inflation might be more acceptable than others. And if you look at, if you browse the copy of the latest inflation report, for example, you'll see in the early pages we explain or we specify the explanation clauses or some of the conditions that I think are considered as acceptable reasons for inflation breaching the target. And these are typically related to factors that are outside the control of the central bank. Things like sharp increases in agricultural commodity prices, for example, and because they tend to be related, as we've seen, related to weather conditions. Increases in oil prices because we're a small economy basically importing crude oil from the global market. Natural calamities, which could produce temporary shortages in key commodities, and even changes in government policy, like let's say an increase in consumption taxes or the VAT. So just those points to add.
Thank you, sirs. One last question from Warren de Guzman of ANC. How do you think recent credit card security issues affect the demand for loans from households? I think he's referring to recent reports of credit card issues. Is it a factor in loan demand?
I don't think it's more on a micro level. So these issues are being addressed. And I don't think that really should be of any, let's say, significance in affecting overall demand. I, for one, am not really worried. Of course, you just have to do your due diligence. No? You have to know whether if you're into online purchases, you have to know that the website that you're visiting is a legitimate website.
Thank you, sir. That's all. Yes, sir.
Also,
Please go ahead.
DG, maybe if you try to look at the discussion of the senior loan officer survey in the latest report, we say according to the survey, the expected or the factors that the banks are seeing as affecting loan demand from consumers is mainly linked to household consumption and also reduced income prospects from consumers. And so I think those are the main factors that are likely to affect, at least based on the survey, that consumer demand for loans over the next few quarters, which is not to say that cybersecurity is not an important issue. I think given the significant shift over the past year towards online financial transactions, so I think it's become more of a concern also, not just for central banks, but for the banking community. And I think some of our colleagues in the supervision side are working to address some of these issues.
Thank you, sirs.
I'd also like to add that the recent
Yes, ma'am.
action of the central bank to cap the credit interest rate to 2% per month is, well, one is it provides some relief to the borrower, credit card borrower, but also it can also spur demand, because since the interest rate would be lower, then probably the credit card borrowers will be more encouraged to make use of their credit card to purchase.
Thank you so much. At this point, we would like to thank everyone for their time and attention this afternoon. This ends our inflation report for the fourth quarter 2020. We thank all of our viewers on Facebook and our resource speakers, BSP Officer in Charge Deputy Governor Francisco G. Daquila Jr., DR Senior Director Zino Abenoja, Deputy Director Dennis Lapid, and Assistant Governor Eliminada Sicat. We greet everyone. Good afternoon. Maraming salamat po and keep safe.
Yeah, thank you.